every fair value gap that is created has 3 important candles, because the first candle can, well, do whatever it wants. It's the least important one. But then the second candle is always going to be an expansion candle. In a bearish example, it's going to expand below the previous candle low. And then the third candle is the most important one. It's also known, as I like to call it, the tricky third candle. The reason why it's tricky is because it has 3 different options of what it can do. Number 1, a retracement. Number 2 is it can be a new expansion. Number 3, it can also be a consolidation. Now, if it is a consolidation, and let's say it's a weekly fair value gap, and you have a third candle on the weekly time frame that's consolidating, then you have a full week of consolidating price action, where you can potentially lose a lot of your profit. So understanding what these third candles want to do is absolutely crucial. Now, first of all, let's dive into option number 1, which is the retracement that we talked about. I need you to understand the following, that fair value gaps get retraced back into due to resistance areas, due to opposing PDRAs. So what do I mean by that? So for example, right here, we trade above this swing high right there. This swing high causes us to retrace back into this bullish fair value gap to then continue higher from it again. The same what we have right here. We have this tiny bearish fair value gap right there. That bearish fair value gap gets traded back into because we sting into a bullish fair value gap right there, which doesn't hold, but it does create a retracement back into the bearish fair value gap to then continue lower. Now this leads us to the most recent example. We use the replay tool right here. Then on the weekly time frame, what we see is that we have this expansion phase candle right here. So the second candle of that fair value gap. If we go up a time frame, then you'll see we also have a monthly fair value gap that we have a sting into right here. This monthly fair value gap can cause a potential retracement back into the weekly value gap to then continue lower from it. So in other words, if the third candle stings into this monthly fair value gap, the resistance area, it has a reason as to why it might stop or retrace a little bit. Now then the question of traders might be, well, Arjo, if you say that, and if we do sting, like here we sting into that monthly value gap, and we do create a retracement, like we indeed see right here, then this retracement right here, that can simply be traded, right? Because if this ping pong effect is in fact true, where we reject from a bullish fair value gap back into a bearish fair value gap to then continue lower again, then you can capitalize and profit from both the buys and the sells, right? No, not necessarily, because both sides of the market cannot be high probability, because that's not how momentum in the market works. In order for one side, so the bullish or the bearish side, to be high probability with its momentum and have great delivery on the lower time frame, then the other side needs to be sacrificed. In order to be bearish, price might need to be 80% bearish and let's say 20% bullish. That 20% bullish right there is just enough bullishness to create a retracement in the first place. But the 80% bearishness, that's there to create a bearish trend overall. So in other words, if you only have 20% bullishness going for you and you're trading against the overall higher time frame momentum, then what does that mean? That means that lower time for price action will really struggle to push price higher right here. Why? Because it's against the overall momentum. So you won't have perfect stings into bullish fair value gaps right there to simply continue higher. It will struggle, and it will really struggle to create those new fair value gaps to continue higher from again. But you might say, okay, well, it's still delivered, right? It's still delivered higher overall, so why not trade it? It's because trading also requires, to a certain degree, good price action on the lower time frame, good accuracy. Because if you consistently try to profit from a certain direction in the market, but you take loss after loss after loss, even though the direction plays out, then it's still not worth it mathematically. You're still not going to be profitable. Every single trader, profitable or unprofitable, can take a winner once in a while. That's not the difficult part. The difficult part is, and what makes a trader profitable, is not having more losses before you take the next winner. Because logically speaking, if you always target 2 RR and you take 3 losses before you take the next winner, then you get a -1 RR total. And that's quite important to understand. Now, a rejection from these resistance areas right here, it's not always guaranteed. We have to confirm it. And we confirm it by paying attention to the previous candle low right there. This is exactly what leads us to option 2, where we create an expansion. We are looking at GBP US dollar, and we're looking at the daily time frame right here. Now, by looking at the daily time frame, we see that we have a few swing highs right there, which could potentially cause a retracement into this future fair value gap right here to then continue higher from this future fair value gap. But what is important to understand, this depends a lot on what happens with this previous candle high right there. Now, I believe you also require a trend to a certain degree to capitalize, so to profit from a trade ID. Meaning that we should move clearly from point A to point B. If we don't and we stay in the same place, then we're looking at a consolidation, which is not ideal. So that means if we do want to trade a third candle, then it should ideally be a new expansion phase candle. Meaning the reason why this second candle of a fair value gap is an expansion candle is because it expands and closes with its body above the first candle high right there. And if the third candle wants to be an expansion, we want to see the same exact thing right there, but above the second candle high, which then in turn, once that happens and it becomes a new expansion, this right here turns into a breakaway gap. So if you are trading a third candle, then know that you are essentially trying to predict a breakaway gap. And a breakaway gap is a fair value gap that we don't trade back into. So how can we predict that? Again, the previous candle high right there is important. And going and understanding what the lower time frame story is. So if we go from the daily time frame to the 4-hour time frame right here, and we keep that previous candle high right there on our chart, then we see the first time we reach above the previous candle high, sitting right there, we are wicking it, and we are wicking it multiple times, which tells me that we are respecting this high right there. In other words, we are struggling to push above it. Now, understanding if we can trade this third candle is all about understanding the willingness of price. So if we zoom out again and we go back to the daily time frame, then if a candle forms like this, so we have a new expansion above the second candle high, creating a breakaway gap right there, then what does this candle look like on the lower time frame? It's simply fair value gaps already holding towards one side of the market. So if we go down time frames, it's simply price already telling us that it is already willing to continue higher. How do we know that? Well, here we have this bullish fair value gap sitting right there. And this bullish fair value gap, once we retrace back into it right here, we have a sting into it. We have a long wick at the bottom. We trade back above this previous candle high, which tells us we are not struggling anymore with that previous candle high. We have a large up candle right now. And this tells us right here that we're not struggling to push higher. So there's already willingness to push higher right here, where we can see price is simply continuing higher right there. So the trigger for this is once we do see that willingness of price to already continue higher, by respecting these fair value gaps, not struggling to create new fair value gaps off of that, and then reaching above the previous candle high again, that right there is a trigger to go into the lower time frame to look for a potential entry as well. Now, to clarify this a little bit more, we need to understand the third option, which is that consolidation third candle. A consolidation third candle is arguably the most tricky one, but also in some ways the most ideal one. Now, why is it tricky, but why is it also ideal? It's tricky because here we are looking at the weekly time frame, and it's tricky due to the fact if we do consolidate on the third candle right there, it makes it tricky because it's very difficult to profit from that and not ideal to even trade in the first place if we have a full week of a potential consolidation. But it's also ideal on the other hand that if we do consolidate with a third candle, we have a very easy path to trade back into the fair value gap that's going to be created to then continue lower from it. So it's a double-edged sword essentially. But the most important part is when we do consolidate that you want to stay out. So how do we spot that again? Well, here we had this monthly fair value gap sitting right there, which could potentially cause a retracement. We have the third candle and the previous week low sitting right there. The third candle opens up right there. Now, when the third candle opens up, you want to do the exact same thing that we did with the breakaway gap, essentially, with the expansion candle, the option 2. And that is you want to monitor the previous candle low in this case. And if we monitor the previous candle low, then what do we see in comparison to what we saw earlier with the expansion candle? We see that when we do trade below the previous candle low in this case, there are signs that price is not willing to already continue lower. And when price is not willing to already continue lower, it's very likely to create a consolidation. In the MMT, we had a live session at this moment in time. And we saw this fair value gap that price wanted to continue lower from potentially. Everything up until that moment was arguably perfectly fine. Nothing wrong with it. Now, once we opened with this next candle right here, this is where it all went wrong. This is where we had a sign of a potential consolidation. Why? Because now price is struggling to create new bearish fair value gaps in the first place right there. So that tells us price is potentially not very willing right here to already continue lower. So during the live session, we mentioned right there, this could very well turn into consolidation right here and a consolidating third candle for the remainder of the week. And what we see afterwards is that we never create these bearish fair value gaps right there. So we always struggle to push lower. Now, we also arguably struggle to push higher. Why? Because that's against the momentum. So in other words, what are we looking at? We are looking at a consolidation right here. And that then results eventually into a consolidating third candle right there where we don't do anything. So ideally, you want to stay out. This is how we can actually objectively somewhat understand what is happening in the market. Now, if you're interested in learning more, feel free to also take a look at tradingmmt.com. We have 2025 module also coming up. And if you do have any questions, then feel free to reach out to info@tradingmmt.com. All right, perfect. Thank you.